Hello everyone, and you're watching Bitcoin Bubble news channel. The space is worth $2 trillion right now. There are going to be a lot of them. The market cap or the log regression channel of the price of Bitcoin were used to figure that out. There are that many ways to cut it back. Of course, I could be wrong by 50%. It will reach 50 trillion by 2032 or 2034. That's why the job is to follow that path. It's not because some people don't get that it won't be a $50 trillion Bitcoin world. 10 trillion Bitcoins could be worth it. Well, 40 to 90 trillion dollars will be made somewhere else. That's what hedge funds can do. Raoul Pal and Tushar Jain have an interesting conversation about the future of cryptocurrency. They talk about how they see it growing to be a $100 trillion business by 2032. They look into more than just Bitcoin and Ethereum, focusing on the hidden potential of low float tokens and the transformative power of blockchain in changing the way economies work and how value is created. Pal interviewed Tusha Jain, who talks about how blockchain can be used for coordination, token economic design, and value capture, focusing on DeFi and Solana as examples of useful assets. Raoul Pal said that by 2032, the Bitcoin market would have grown from $2 trillion to $100 trillion to $100 trillion. He said that to get a piece of this boom, people should look beyond Bitcoin, Ethereum, and Solana. He used the example of hedge funds to show how they can find alpha and handle risk. Pal said that hedge funds have money on the line and need to focus on risk-adjusted profits. He also talked about the behavioral economics of network effects and token value, which suggests that we still don't fully understand them. Raoul Pal saw low-float tokens as a chance to make money, pointing out that known quantity and lower prices create an uneven risk-reward situation. He thinks that the industry will grow a lot and that value creation will reach $50 trillion or more. You can learn more about what Raoul Pal said by watching clips from the talk. If you want to see more videos like this one, please like it, subscribe to the channel, and turn on post alerts. Have fun with the movie. I also made a company called Exponential Adjusted Management based on this idea because I believe hedge funds are the best way to get alpha in the market. The crypto markets will grow from about $2 trillion now to around $100 trillion in 2032, I think. That's a huge increase, and Bitcoin, Solana, and Ethereum alone won't be able to cover it all. It's really hard to move further out on the risk curve, but we need to be able to. I'm not able to do it. This is something that hedge funds do really well. This is what they do. They spend all their time looking for alpha and chances. I really enjoy talking to hedge funds because they have a lot of money at stake. The money they have comes from both their own savings and money from investors. That's why it's their job to focus on the best chances based on return compared to risk. I was in the blockchain class of 2013 too. It was one of the first things I saw that would change the game in terms of both capital creation. The behavioral economic side of this is about how people's interests come together. As more people join a network, the value of each token goes up because of Metcalfe's rule. This makes the network more valuable. And that lets you start businesses very quickly. That's still something I think people don't fully understand what it means. Indeed, we are now seeing some strange rewards like airdrops or ways to farm it. I believe the initial coin offering ICO was the start of something much bigger. These low float coins have also been on my mind. And the first thing I think is that the market now discounts them. Because of this, you have a good chance to make a choice in markets that are liquid. Since you know what to do, I think you should decide what to do. That's no longer an option. When supply and demand are unknown in a normal market, things get difficult. If you know the demand but not the supply, you can model something and the other way around. When I look at these, I think I know what the supply is going to be. Because we now have the unlocks, because there aren't many of them, the tickets have been marked down. Then you know that if demand does come, the beta of a low float is huge, and I think that will destroy everyone's idea of what a low float means in this bull market. They will all be wrong. And they'll be wrong because there won't be a lot of float, but there will be a lot of demand because some of these projects are really great. This will make the risk returns very uneven. No one seems to get this because they think that future token unlocks always mean the price is going down. Yes, during a bear market, some will likely fall more than others. However, I find this very interesting during a bull market with a very small float. The space is worth $2 trillion right now. The amount I think it will reach is $100 trillion. If you look at the market cap or the log regression channel of the price of Bitcoin, that's all it is. There are that many ways to cut it back. The number goes up to 50 trillion by 2032 or 2034, so I might be 50% off. So the job is to follow that path. People don't get that it won't be a $50 trillion Bitcoin world. 10 trillion Bitcoins could be worth it. Well, 40 to 90 trillion dollars will be made somewhere else. That's what hedge funds can do. Since that's a tough job, you have to be very focused to figure out where the big value gain is. In the same way that you did with Solana, you see something really early on and it's already added a lot of value and it's not over yet. And that's what I see as the bigger chance. People need to step back, not worry so much about the cycles, and just think about how to catch that trend. I believe that is the biggest and fastest buildup of wealth in the history of the world. Tushar Jain said that the start of Ethereum in 2016 was a big deal because it showed how blockchain can help people work together and make new products. He said that blockchain is a tool for coordination that could let people work together and align their incentives to make things that are useful to the economy, things like DeFi and stablecoins, which can't work without blockchain. Tushar Jain also talked about how important token economic design and value capture are, saying that his team has done a lot of study on these topics. He looked at how coin lockups and float are different in the venture and liquid crypto worlds. He stressed how important it is to have useful assets like Solana and Helium, which make things instead of financial assets like Bitcoin. To learn more from Tushar Jain, let's watch more clips from the talk. I was very excited when I saw crypto. When I learned about Bitcoin for the first time in 2013, I bought two. I wish I bought more. There are many people who wish they had bought more back then. But Bitcoin wasn't for me at the time because it was all about hard money and Austrian economics, which are things I understand and value but don't really fit with who I am. In 2016, I saw Ethereum, which really got me excited. Ethereum showed me how blockchain technology could be used to get people to work together to make things and do things they couldn't have done otherwise. That was our goal. At their core, crypto or blockchains are a way to coordinate things. They are meant to help people work together and make sure that their incentives are aligned so that they can make goods that are useful to businesses. Protocols that let them do something that wouldn't have been possible otherwise are always what we look for. This is shown in an interesting way by DeFi. Or DePIN is another really cool method that does that. They are making things that are useful in the real world, like stable coins. These things would not be possible without the financial ledger and coordination technology called a blockchain. At least that was our main point from the start. Following that, we looked for different situations where we could use that theory. We then had a list of factors for investments that came after the entry price, because, well, obviously that's important. It goes without saying that what value capture looks like is important, right? It seems like we're venture investors instead of venture philanthropists. So, we're looking for things that can make money for us and our clients. So we looked at a few different token business plans. That's where I think we put a lot of attention at the time, especially in the early days when we were betting on leaders. People were putting money on them because they thought this sounds really good. They're putting money on ideas. A lot of work went into things like the token velocity problem, how to build a token correctly and incorrectly, and what kinds of tokens will capture value and what kinds won't. Because the money side of rules is not the same as the money side of businesses. The investment crypto community and the liquid crypto community have different ideas about how the world should work. People in the venture crypto community believe that long lockups show that incentives are aligned. They also say that this is a good thing to do because it shows that you're in it for the long run and not just to make quick money or flip the theme. But the crypto markets that trade a lot of coins think that projects with low float and high FTV are hard to invest in.